The Standard & Poor's 500 Index, short for the S&P 500, is a stock market index that tracks the performance of roughly 500 of the largest publicly traded companies based in the US. And because of that, the S&P 500 is widely regarded as the best single gauge of large cap US equities, where it covers approximately 80% of the available market cap in the US. In fact, the S&P 500 since 1980 has grown on average just over 12% per year, which would have turned $1,000 into roughly $176,000 by today. And a famous quote I like to refer to here is from the founder of Vanguard, Jack Bogle, who actually helped create the first S&P 500 index fund, where he said, "Don't look for the needle in the haystack, just buy the haystack." Knowing that, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, to get straight to it, the first one I'm going to cover is the SPDR S&P 500 ETF Trust with the ticker SPY. Now, SPY is the world's most traded ETF, averaging about 73 million shares traded per day over the past 3 months, where that high level of activity makes it extremely liquid, allowing investors, especially active traders, to buy and sell with almost no impact on the price. Not to mention, but SPY is also one of the top 3 most widely held ETFs, with over $683 billion in assets under management, where it has a bid-ask spread of 0%. Now, the bid-ask spread is essentially the difference between the highest price that a buyer is willing to pay compared to the lowest price that a seller is willing to sell for. So because of its massive trading volume, tight spreads, and deep liquidity, SPY is often the top choice for active traders and those using option strategies on the S&P 500. But the trade-off is cost, because SPY has the highest expense ratio among all the ETFs I'm mentioning, where it has a 0.0945% expense. The expense ratio is simply how much it costs to own the fund per year, and do know that that amount is automatically distributed throughout the time of owning the fund. You don't have to pay anything separately. But the difference here is, say that you were starting with $1,000 and you invest $500 every month into the S&P 500 throughout your entire career, getting a 10% annual return at a 0.1% expense ratio. After that length of time, you would have ended up with a portfolio worth $2.6 million, but paying over $72,000 in fees. Now, that amount of fees is much better than something that is actively managed that may be 0.7% of an expense, and with that scenario, you would end up paying $470,000 in fees throughout your career. It's a huge difference. But the reason I am mentioning all this is because if you are simply planning to buy and hold the S&P 500 for a long time, you can get even better results, because there are even cheaper options out there for you to own the exact same index. For example, the next option I'm about to show you has a 0.02% expense ratio, and after 40 years, the total amount in fees would drop instead from $72,000 with SPY to now being under roughly $14,000. That is the difference of over $50,000 from knowing this and just a click of a button to make the change. To me, that makes it well worth hitting the like and subscribe button. But as far as SPY, the fund currently has a 30-day dividend yield of 1.03%, with the returns over the past year being 17.42%. The average annual return over the past 5 years was 16.3%, and over the past 10 years, that average was 15.15%. Fun fact to know about SPY is that this fund goes all the way back to 1993, as it was the first US listed ETF, which, by the way, all of the returns that you are going to see already include the expense ratio factored into it. But knowing that, let's move on to the next ETF, that is the SPDR Portfolio S&P 500 ETF with the ticker SPLG. And please note that during the editing process of this video, State Street made a change effective on October 31st, 2025, that SPLG has now changed its name and ticker symbol to be labeled State Street SPDR Portfolio S&P 500 ETF with the new ticker symbol of SPYM. If you didn't notice, this S&P 500 ETF is also through the same company that is run by State Street, but as I've mentioned in previous content, the difference between the two is pretty much the exact same as QQQ versus QQQM. You see, between these two, they both track the NASDAQ 100, but QQQ has much higher liquidity, making it more ideal for active traders, where QQQM has a lower expense ratio, making it more ideal for long-term buy and hold investors. So the same concept now applies to this S&P 500 ETF SPLG, as the assets under management are at $93 billion, but more so that the average trading volume is lower at roughly 9 million shares, where the bid-ask spread is 0.01%. All in all, for long-term investors, the choice between the two comes down to the expense ratio, and for this one, it is 0.02%. But do know that SPLG currently has a dividend yield of 1.11%, and over the past year, it performed better than SPY, as it grew 17.54%. Over the past 5 years, that was 16.45%, and over the past 10, the average was 15.23%, where this fund was officially created in the year of 2005. The biggest thing to notice here is that because that annual expense is lower, over time with many years to invest, that will impact the returns, and that's exactly why the returns for SPLG over time are slightly higher than those from SPY. With that said, the next fund on my list is the iShares Core S&P 500 ETF with the ticker IVV. Now, IVV has an expense ratio of 0.03%. The total assets under management is $683 billion, with an average daily trading volume of 6 million shares. The 30-day bid-ask spread is 0%, with a dividend yield of 1.06%. And if we look over the past year, this fund grew 17.5%. The average over the past 5 years was 16.5%. And over the past 10, that average is 15.3%. Knowing that, moving on to the last one that is a very popular one, being the Vanguard S&P 500 ETF with the ticker VOO. For VOO, it was created in 2010 and has an expense ratio of 0.03% with a total $777 billion in assets under management, a daily average trading volume of 7 billion shares, with the bid-ask spread also being 0% and a dividend yield of 1.12%. For this, if we look over the past year, the fund grew 17.5%. The average over the past 5 was 16.4%, and over the past 10 years, it was 15.26%. So to break down the choice between these S&P 500 ETFs, I would only choose SPY if you plan to actively trade, and then for those that are long-term investing, I'd recommend to pick whichever one of the others that stands out to you most. They all provide similar results, and the most important thing thereafter is to actually start and stick with a plan. Now, if you want to learn more about each and see other top index funds, I've created an entire index fund cheat sheet for you that I'll have linked in the description below. And don't forget, if you want to start investing on a new platform, I'll have a direct link in the description below to some of the top ones that you could learn more about and get started with. End of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth, so please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. Now, if you did find value in this video, don't forget to hit the like, subscribe, and notifications button for future content like this.